All right, I'll go ahead and get started, kick it off here this evening. So, welcome everybody to our Balance Wealth November webinar on financial clarity before the close. And we thought this would be a helpful webinar just to kind of high level think of the things that you should be doing or at least considering leading up to the end of the calendar year, just in case there's anything that's kind of hanging out there that you can take advantage of to put yourself in a better spot and to get ready for 2026. So really that's the goal here, is to end the year financially confident and ready for 2026. And there's a lot of different things we can do. We'll go through it. But before we do that, I want to say thank you to our veterans. It's with a ton of gratitude that, we're here today, and so much of it is because of our veterans. We have a couple here on the team as well, and sharing some pictures of Adam and Shaun and their families, right? And Shaun is actually out on deployment right now, so he's not able to join us this evening. So not only veterans, but also our active duty military, all the folks that are out there keeping us safe. So huge thank you and gratitude to all those that serve. So getting into our agenda for today, we're going to talk about a number of different strategies that leading up to the end of the year, we either want to just consider or start to build a plan for or around. And, as we go through these, tax loss harvesting, reviewing our contributions and or required minimum distributions, capital gains and dividends, just reviewing our investment performance or growth or anything we've realized. We'll talk about Roth conversions, charitable giving. I'll go through some live examples as well. And then, of course, we'll have plenty of time for Q&A. What I'll say about the Q&A, just like all of our other webinars, please enter questions into the chat as they come up. So if you have anything as either Nora or I are talking through, just go ahead and ask them. Throw them into the chat. Ryan will keep an eye on them. Nora will keep an eye on them, and we'll either answer them right then at that point in time, excuse me, or we will save them for the time that's appropriate. So please ask questions. Please feel free to butt in. The other thing I'm going to say is with all of these, we're going to keep it relatively high level. We are not going to dive really deep into any one of these strategies. The goal here is to identify them, share with you what they are and how they may impact you. And then you can say, hey, you know what, Bob, Nora, Shaun, Adam, Tyler, whoever it is, I'd like to learn more about this one. And beyond that, also the three that I have highlighted here, we've already done 45-minute, hour-long webinars on these three specifically. So if you want to, after this one, go review them, you can always find them on our website. So these three, again, specifically, we've already done in-depth webinars on, and I encourage you to go watch them. Especially one of my favorites is the Roth conversions, number 4. But the tax loss harvesting, capital gains, dividends are also great ones. So if you go to our website, the media tab, you click on that and it brings up all of our different webinars that we've put together and all of our different podcasts that we have. So go ahead and hop in there. So, I sort of introduced Nora as we got into this, but Nora is joining me here this evening. So I'm going to hand it off to Nora so she can kind of start off with tax loss harvesting, and we'll just kind of pick it up from there. So again, folks, please ask questions, let us know what you're thinking, and we'll go from there. So Nora, it's all yours.
All right. Thanks, Bob. And catch me if I go into too much detail, because I feel like it's sometimes easy on these topics to just say too much. And so, like Bob
Mhm.
said, we really just want to educate you of some of the options to consider. It may not qualify for you. All of these may not be an option for you, but let's take that offline. If that just you have questions on it, or you're just wondering, hey, I want to learn more about it, or does this make sense for me? We're happy to meet after this. So
Mhm.
we'll kind of start off with tax loss harvesting. And as Bob mentioned, Nick and Bob do a wonderful webinar, 45-minute webinar on tax loss harvesting and direct indexing. If you want to know absolutely everything about that, definitely watch that webinar. It goes into great depth about those two things. So kind of in general overview, what is tax loss harvesting? And so really it's the strategy of selling investments that have declined in value to realize some of that capital loss, which then can offset some of those capital gains. And we'll kind of go through some examples, or some ordinary income to some extent, which thereby will lower your tax bill. So here's kind of a general graph that, really is not specific to anybody, but I'll try to pull in an example. So I have a client that has some RSUs that have vested, so they're heavily weighted in a specific stock. So I don't know, Bob, like what stock should we use? Just send out any type
Tesla.
of Tesla.
Everybody loves
Okay.
Tesla. Yeah.
So they started working for Tesla. They have a ton of stock in Tesla, and that capital gains is outrageous, right? And so we're looking from a risk standpoint. You're heavily weighted in Tesla. So what can we do to kind of diversify that portfolio? So in this example, one of the things we can kind of do is look at some of the funds maybe in that account, that portfolio that have a capital loss. So for example, let's say another fund in this client's portfolio has a capital loss. We take advantage of it. We sell that fund and we realize 6,000 of capital losses. Well, one strategy we can do is sell some of that Tesla stock, right, at a capital gain, realize 10,000. And when you offset those, you're only going to net taxable gain is 4,000. So those are some of the strategies that we can use to really take advantage of reducing some of that risk in that specific example, when you have some capital gains, and then also realizing some of those losses. So that's kind of an example where we would use tax loss harvesting. One of the questions I really get a lot is, let me see here, I think one just came in the chat. What kind of accounts can you use these in? Great question. And so the accounts that you can use tax loss harvesting are really those taxable accounts. So think brokerage accounts, individual joint brokerage accounts, not necessarily your IRAs, your 401ks, your Roth IRAs. So that's a really good question. So thank you for asking that. Another key thing that we like to do, obviously end of year planning, deadline is December 31st, to make sure that you take advantage of all these losses to realize them for 2025. As we kind of went through that example, a deduction is to offset some of those capital gains that you may have. But let's say your losses exceed your capital gains, you can realize up to 3,000 in ordinary income for one particular year. Note that you can carry over, so that's one of the strategies that we can work with you on as well. But 3,000 you can realize per year, per taxable year.
Mhm.
And then we kind of just threw in an IRS rule. There's a wash sale rule that says you can't, sell the S&P 500, realize that loss, and then buy it the next day, right? Or even before that. So there's a 30-day window before and after buying a fund. So we can't trick the market and take advantages of these losses and get back in. So that's just one thing that we kind of monitor when we do these things. And another question that we get a lot is, well, when should I be doing tax loss harvesting? How often? And really, you can do it throughout the year, right? There's key
Mhm.
things that we look for when to take advantage of this is one, we'll monitor if there's a big dip in the economy, right? We'll take a look at your account to see if there's any advantages that we can take advantage of. Obviously, before the end of the year are just some key things. Quarterly, we can monitor, and a lot of clients aren't aware, but we actually do this in your account to take advantage of. So
Yeah,
kind of some key
Nora,
things.
that's a great point. Yeah, we'll do this proactively. And the wash sale rule is an interesting point. And again, Nick does a really good job in our other webinar talking about this. But one of the things like, you can't do like to like you can't sell Tesla and buy it back to get the, capital loss, but you could buy a certain, ETF that's a large cap, equity ETF and buy a very similar, but not the same large cap equity ETF, and that goes around the wash sale rule. So there's ways to get around it and take advantage of this. And I think that the important part is just reviewing it both for we had a really good year this year in the market. So there's not a ton of capital losses in there. But it can be on an individual basis that these come up. And even some bond funds is what we found with as interest rates went up, bond funds decreased in value, and potentially there's some work that can be done there too. So again, it's just about the review, knowing that it's out there and being able to take advantage of it. So just kind of keeping it moving forward. We'll talk about contributions, and Nora, you could pick it back up with contributions to your different accounts.
Great. So first, this is a graph just really shows you, so I don't want to read it, but I'll try to apply specifically to certain situations and examples that we've seen. So 401ks, 2025 contribution limit, 23,500 with 7,550 and older. A couple key things to think of here is if you, in your financial plan, what we always recommend is, at least hit that company match, right? So let's say, for example, that your company match is 6% of your salary. You take advantage of that. That's free money. We don't want to leave it on the table. But you come to Bob and I and you say, you know what? I have, let's just say, for example, 10,000 in my 401k. I'd love to see if I can max that out for the rest of the year. The caveat to that is if you are an employee, contributing to an employer's 401k, it has to be a salary deferral. So it does come out of your paycheck. So when you say, hey, Nora and Bob, I want to fund 13,500 and I have a month and a half to do it, know that that will be your pay out of your paycheck, whether that's part of it or all of it. Just know, consider that when you're saying you want to max this out. Now, looking at kind of who's on the webinar right now, I know we have some self-employed individuals on this webinar. So if you have a solo 401k, you don't necessarily have to do a salary deferral because more than likely you're not paying yourself, a paycheck. So for those with solo 401ks, you can contribute kind of one-time check, but just know that that has to be from business income. It can't be from your individual savings account or anything like that. So when we say things to consider, I know you have a month, a month and a half left to contribute, but those contributions have to be in by December 31st.
Yep.
Going into the Roth IRA, those do not have to be in by December 31st. You have until April 15th of 2026 or the tax filing deadline of the following year to contribute, or whenever you file taxes. So that's also something that you can definitely take advantage of past December 31st. And that can just be, hey, let one of our advisors on our team know, hey, love to max this out or what have you. Can do that through tax filing deadline. And then we like to talk about the HSA. So that's health savings account. Really unique. If you have this, you have to have a high deductible health plan. We have several clients that have those and are contributing, but if you can take advantage of an HSA, it is extremely powerful. And we have several podcast snippets about it, webinars about it, triple tax advantage. So we can talk in more detail about that. But HSA max contributions are listed right there. I would note that if you and your spouse are offered an HSA, note that as a household, you can only contribute $8,300. You can't each do $8,300 for,
Yep.
16,600.
And just to that point, Nora, the 8,300 also takes into account the employer contribution as
Exactly.
well. So if you have an employer that's putting in, $2,000 on your behalf into your HSA, that means you personally can only put in the 6,300 to potentially get to the max for the family plan. So just be mindful of that. But this is also one, correct, Nora, that you can do after the end of the year. So you can go back and just write a check and say, hey, I want to add to my HSA or whatever. Most of the time you defer into your HSA from payroll deductions, but you can add to it after the end of the year to kind of maximize your contributions for the tax year.
Seven. And one of the things that we didn't include on the slide, but I do like to just mention it as end of year. And typically it's at the beginning of the year when we start planning, but kind of hand in hand, they're different, but we do have a lot of questions when we meet with clients about it. Is it HSA versus an FSA, a flexible spending account? So just note, if you have a flexible spending account, it's typically a use it or lose it. So if you're nearing towards the end of the year, I want to make sure that you're taking advantage of that and not leaving money on the table. So if you have medical expenses, make sure you're taking advantage and using those FSA funds. Now, I have a couple clients that have plans that allow you a small carryover amount, but it's completely different than an HSA, different tax rules and things like that. So if you do have an FSA, make sure you're taking advantage of it. And then I know I have some younger, or some clients with some younger kids on this that signed up for this webinar. So there is what's called a dependent care FSA. As we're planning towards the end of the year, similar to like an HSA, there is a max contribution you can do. And a dependent care FSA can cover, daycare costs and, things like that, whether it's in your home or you're sending your kids. And we all know daycare costs are outrageous. So for
They can be expensive.
2025, you can contribute up to 5,000. So again, if you're have room in your plan and you're wondering where tax advantage ways you can save money and you have kids that are going to daycare, you are already expensing that. You might as well get the tax benefit. Make sure you max out that dependent care FSA at 5,000 for the year before the end of the year. So just a couple things contribution wise that we want to make sure you're aware of, and if it makes sense and how you can kind of contribute to those.
Yep. Absolutely. So, and then on the flip side of that, sometimes you have to take distributions. So, anybody that's getting up there and getting into the retired years, required minimum distributions come through. So, when do we need to start thinking about these, Nora?
Yeah, so we're all familiar with tax laws changing. So it was the Secure 2.0 Act that had updated these years. So we always like to remind people of this. So if you were born from 1950 or before, your first year of RMD starts at 72. The Secure
And it was
2.0 Act.
70, and it was 70 and a half before. So it was that 70 and a half, 72, right? But this is just like this captures all because
Yep.
1950 is already passed. So,
Yep, exactly.
mhm.
And so the act passed, and so if you are between 51 and 59, which we are right now, it's 73, and then 1960 and older is 75. So we have some time to get to that point. But a couple things I want to note about the RMD is one of the questions that we get is, okay, if I turn 73 in 2025, when do I have to take my first RMD? Because that's a little unique versus every year following that. So
Mhm.
say, for example, you turned 73 on February 1st, or maybe you're turning 73 December 1st of this year. You have until April 1st of the following year, so April 1st, 2026, to take your first RMD. Now, when we meet with clients this first year, we want to make sure that we're saying, okay, if you want to delay that, know that you will have two RMDs for 2026. And reason why we want to make sure that's important to know is that that potentially could jump you a tax bracket, incurring more
Mhm.
taxes. And so that's one thing to start considering. If you have questions and you're not sure when to take it, reach out to us. Just know that first year you have a little bit of an extension until April 1st that following year. And then every year after that is December 31st.
Yep. And
And then,
one quick other point here.
yep, don't forget those beneficiary IRAs. Another tax rule that had changed with the Secure 2.0 Act. You don't necessarily get that stretch, right? IRA that we saw for anyone that had been deceased. I think it was before January 1st of 2020. So
Mhm.
we all know we're in the greatest wealth transfer in history right now. So we are seeing a lot more of these inherited IRAs, inherited Roth IRAs come through. So if you have a loved one that has passed after January 1st of 2020, no, unless you are a spouse, so any non-spouse, that you have what's called a 10-year rule to take that distribution. And so that starts, I think Bob, is it January 1st again of the following year
Mhm.
of
Yep.
the deceased. And so if you had someone that passed earlier this year, that 10-year clock starts January 1st of 2026. And the reason
Yep.
why it's important to make sure that you're aware of this and tracking it is you don't want to come 10 years down the road and, oh no, I have to take this full distribution, right?
Mhm.
So we have worked with clients to take incremental distributions throughout that 10 years so you don't jump tax brackets. You're not realizing this huge gain, but you are required to take that distribution in full by year 10.
Yep. So just being mindful of it. And if you have an inherited IRA, an inherited Roth IRA, make sure that we're getting those distributions done. It's something we track for clients, but just as a reminder for everybody. So, jumping over and kind of moving on to the next one here, just reviewing capital gains and dividends as we go through this. So, capital gains and dividends are just growth on your investments. Now, this is tied, as Nora mentioned earlier, with tax losses. This capital gains and dividend is going to be tied just to brokerage accounts, right? So non-IRA, non-Roth IRA, non-401k dollars, right? So it's any appreciation that you have in the investments that you hold. If you go to sell it, that is going to be a capital gain. And then dividends are just distributions out. But the one thing that I want to note is specifically on mutual funds. So if you have any mutual funds that you hold in a brokerage account, I want to go through this example quickly, just because we want to be aware of what are called capital gain distributions from a mutual fund, which are taxed differently than long-term capital gains. So this little chart here, again, I just stole this from Nick's webinar that he did a few months ago on this tax loss harvesting and all that. So even when markets are up or down, the little red line is the average mutual fund capital gain distribution as a percentage of the fund. So we can see it can be as high as 12% sometimes and as low as only 2%. But the reason that this is bad is because of the way that these capital gains distributions are taxed. Because if you have a $100,000 mutual fund and they do a 10% capital gain distribution, that's basically just taking a cut of the pie and sending it to you, right, as a capital gains distribution. But what happens is if you're reinvesting the dividends, it just gets reinvested right back in. So you still have 100,000 in that mutual fund. However, the IRS is going to tax that capital gains distribution at ordinary income. And so effectively, you're paying ordinary income tax rates on a holding that potentially you could get capital gains tax on if you just sold it, right? So, one of the reasons we love ETFs in general for our investments for our clients is because it avoids this issue right here. So, if you have any legacy mutual fund holdings or mutual fund holdings that you've been holding because you don't want to pay the capital gains, it could make sense to sell those to avoid some of those capital gains distributions. And one thing we can do is we can just run a report. And this is something that Nick just ran for us just a few days ago. That's just an example. These are a list of different mutual funds that just have their capital gains, what they're estimated for 2025. And you can see a couple of these here have 12% capital gains distribution. So if you have $100,000 in there, you're going to get hit with 12,000 of extraordinary income without if you just sit and hold this mutual fund. So potentially selling it because you could realize capital gains, which are always lower, right? So if we look at this chart here, the green and the gold are ordinary income. So that's just your earned income, what you get from your job or paychecks or whatever. The gold is short-term capital gains, which is what the distributions from mutual fund gets taxed at, and the black is long-term capital gain tax rate. So as these come out, you're going to get hit with the higher rate. Whereas if you just sold the mutual fund and moved to something new, you could get taxed at long-term capital gains, which could be hugely beneficial. Okay. So again, I know I went through that quickly and very high level. There's a much more detailed one that Nick goes through, but being mindful of these and understanding the holdings you have in your investment portfolio can be very important to kind of being successful when it comes to um, you know, long-term taxes and investment strategy. So next one we're going to talk about is Roth conversion. So I'll just quickly go through the examples, and then Nora, I'll hand it off to you to kind of go through, what it means and talking about income acceleration and all that. But basically, a Roth conversion, I think many of you know about this. And again, we have a full webinar that I did on this last year that goes through the reasons why we love Roth conversions. But it's basically taking your IRA that has, say, $100,000 in it and converting some portion of it over to Roth. And what happens is if you take $10,000, you convert it over to Roth, you pay taxes on that $10,000 as a, excuse me, distribution. But now that money just starts growing tax-free, which is the benefit of a Roth IRA, versus continuing to grow in your IRA. So they can make a lot of sense when income is lower than normal. So for a lot of folks that retire and see an income dip, we take advantage of Roth conversions. And it can even make sense if like you're in your working years and one spouse leaves the workforce. So income goes down for a year, or you start a business and income is down. Taking advantage of Roth conversions at any stage in life can be beneficial. And one of the reasons I like them best, and actually a reason I just talked to clients about it today, is to minimize required minimum distributions in the future. So as we do these conversions, there are no RMDs on Roths. So it removes some of the weight of those required minimum distributions that come as we keep getting older and kind of going through life. So, they're very important, they're very helpful, and they're I think, one of the most impactful things we can do for folks here leading up to year end.
Yeah, Bob, and just kind of hit on this graph, you can obviously read it, but from a Roth conversion standpoint, like you said, ideally it would be in lower income years, right, to make that Roth conversion. As Bob said, it can happen at any time within your life. I had a client that was young that wasn't going to be making as much now that he knew he would be making earlier. And in the next year or two, he would qualify for like a backdoor Roth IRA. So in order to qualify for that, we wanted to do some Roth conversions of his IRA balance so he didn't have a balance, so he wouldn't be subject to the pro rata rules. So that's an example of when you would take advantage when you're younger. Like Bob said, when you're older, kind of that when you retire, maybe before Social Security hits, where your income's really low, might make sense to reduce those RMDs by doing those Roth conversions. So that's kind of the Roth conversion, income deferral out. Those are obviously during the high income years. We want to defer some of that. Income accelerations, again, some of those Roth conversions, low income years, that we want to take
Yep.
advantage of those and kind of, yeah,
And I
go on.
think all three of these tie together, right? So the Roth conversion obviously is what we would consider like an income acceleration, right? It's like, hey, pushing money in. But that could also be income acceleration, could be realizing capital gains, right? We run into circumstances for folks, just to flip back a few slides, not to confuse us, right? But if you retire and you're living off of savings or something like that, you could be in these low income tax brackets here, and you could potentially realize capital gains at 0% long-term capital gains tax rates, right? So that income acceleration doesn't need to just be focused on, hey, I need something to enhance, go buy a car or go, get groceries or whatever. It can literally just be a benefit, a tax benefit to you, taking advantage of and understanding the tax laws. So kind of tying together Roth conversions, contributions, which is going to be the income deferral, and then income acceleration can be any number of things just to try to take advantage of lower marginal brackets while you're in them at any point in time.
Yeah, and
Okay.
Bob, but one thing to kind of tie it back to some of the other topics that we talked about, we had a client that their goal was to leave the most tax advantage accounts to their children. And so one of
Hmm.
the things that you can do, as we kind of talked about with the inherited IRA, instead of, the question would be, where do you want that tax burden? Do you want to realize that tax burden now, have those funds grow in a Roth for them? Or do you want them to realize the tax, consequences of taking that out in the next 10 years? So a lot of different strategies that kind of overlap, but certainly
And
some good things to
that's a great
consider.
point there, Nora. Yeah, not to, but just that's a great point because a lot of times folks think about it and they're like, well, I don't want to pay any more in taxes than I have to. I don't want to send any to Uncle Sam. But, oftentimes, just with how people live and, where they end up passing and when they pass it to their kids, it's a really good chance that you could pass and leave that IRA to your children in their highest income earning years of their lives. And they're going to have to take, whether it's 100,000 or a million or 2 million, it doesn't matter, right? They're going to have to take a bunch of extra income layered on when they're earning the most. And that's paying way more to Uncle Sam than potentially if you just converted at your marginal rate as you sit there right now. So that's a really good point, Nora, kind of thinking multi-generational planning with these sorts of things. Okay. And just to tie that in, so that was a great point to bring up, just thinking about charitable giving and donor advised funds. So we just talked about legacy planning as it plans to kind of keeping it in the family. But if you have anything that you like to give charitably to, it's important to kind of align those with, your long-term goals. And there's a few different ways that we can do this. So the most common one is people just tend to give cash, right? And yes, you get the tax deduction for it, but I'll touch on that in just a second because you often don't. Um, but you don't avoid any capital gains, right? If and the reason I bring that up is with the tax law changes, with the increase of the standard deduction to now for married filing jointly, I think it's like 34, 32, somewhere, it's above 30,000. If you only, and I say only in quotes because we want to be charitable whether we get a tax benefit or not, right? But if you only give, say, $5,000 to your church or some charitable organization, effectively you aren't getting any tax benefit for that charitable contribution, right? Because you're taking the standard deduction and you don't get any benefit. That will change next year. I think in 2026, there'll be a small amount that you will get for cash gifts. But just keep that in mind from a donation perspective that you're really not getting that benefit. Another way you can give charitably is to donate appreciated stock directly to an organization. So, as Nora talked about earlier, say we have that Tesla stock that's highly appreciated, and we want to give $10,000 to our church. An idea is instead of giving $10,000 in cash and then having to sell Tesla and realize the capital gains, I just donate $10,000 of Tesla stock directly to that organization. And whether that's a church, whether that's St. Jude's Children's Hospital, whether that's, Susan G. Komen Foundation, whatever it is, right? You can donate appreciated stock And what that does is it not only gives you that same deduction, but it also completely avoids the capital gains, which is a great thing. And tying this together, something called a donor advised fund, and we plan to do a webinar on this. We have not dove into them. I love this topic and we'll dive deeper. I'm not going to go too deep now. But a donor advised fund is great because you can make a large donation, and we've done this a ton with clients, say 50, $100,000 to the donor advised fund. Then that's under your control, and you can distribute from that at, 1,000 here, 5,000 here, 3,000 here over the course of your life. But you accelerate that cap or that charitable deduction and really enhance what you can do with your gifts and your net after tax benefit. So, just thinking about these things and understanding that they're there, I think is hugely important. And before I know, Nora, there's one that you've had clients run into a lot, which is something called a qualified charitable distribution. I'm going to let you, Nora, kind of talk about how that ties into all this.
So you kind of went over, how you can make it, but let's say, how can you get that distribution or how can you get funds? So you obviously, Bob went through appreciated stock that you have in cash. So this is what we kind of call QCDs, qualified charitable distributions. So in this example, Bob, if you want to go one over it, I think it gives a good
Yep.
comparison. So this, if you withdraw your RMD and then donate the cash, you can see, your final tax liability is 980. But if you let us know, say, hey, I have an RMD this year and I want to fulfill my charitable contributions through my RMD, the final tax liability, there's no taxes on any of the income taxes you won't realize. You won't realize any of the growth, obviously, from the IRA. It's just more advantageous to do your RMD if that's kind of in your arsenal, right? If you're like, I don't need my RMD, so what can I do from a tax standpoint that would not only benefit me, but ultimately, like, fulfill my desire to donate to charity, right?
Yep.
Obviously, that's the most important part. So think about that. If you have an RMD this first year, or you are currently taking RMDs and you're doing charitable distributions, a QCD may be wise for your plan.
Yep. And one thing I'll say is that with all the tax laws, the Secure Act 2.0, all this QCDs, qualified charitable contributions, are or distributions, excuse me, are available to anybody once you hit 70 and a half.
Mhm.
So you don't have to wait until you're in RMD phase to do qualified charitable distributions. As soon as you hit 70 and a half, you can do this. And there's one client in particular that I have. They've been given to their church for years. Like that is, it's very important to them to do that. As soon as the spouse, the older one, hit 70 and a half, what we did is we just switched their monthly tithe over to her IRA so that it was coming as a qualified charitable distribution. And literally, the QCD, the power of it is it does not taxed whatsoever. It doesn't even go to your 1040. It doesn't get taxed. It's not subject to a deduction or anything like that. It literally just goes straight to the charitable organization, pre-tax funds for you. And it's the best way, other than maybe, donating appreciated stocks, right? Which is a really great way to get money to a charity. But a qualified charitable distribution is hugely beneficial and impactful. So I encourage all of you, as you get above 70 and a half, to consider these as part of your plan. Okay. Any questions or anything? Because I'm going to flip over to kind of the considerations and do a little live demonstration on our tax software. Anything that came up, Ryan, that we want to address or go back to before I kind of dive into a little bit different screen?
Yeah, the only question I see that came through was just someone asking if you can explain the pro rata rule for the taxes a little better for the Roths, how that applies.
Sure. Nora, do you want to take that or?
Yeah, sure. So the pro rata rule, there's a calculation behind it, but it's basically saying if you make too much money to contribute directly to a Roth IRA, we can do what's called a backdoor Roth. And one thing when we do that, we look at, is there an IRA balance? Um, if there's an IRA balance, we cannot directly fund the IRA, let's say at 7,000, and move 7,000 to the Roth tax free. You obviously don't get the tax deduction, but there's a calculation the IRS has that the full 7,000 they take into account what the balance of the IRA is, and you will be taxed on that. And so that's why it's so important when you do qualify for a backdoor Roth, and let's say you do have an IRA balance, we do want to look at what options do you have to reduce that IRA balance so we can still benefit from a Roth IRA contribution. One of those is, do you have a side hustle? Can we open a solo 401k to move those funds in there? So there's different things we can look for to avoid the pro rata rule.
Yeah, and another consideration is, so just to go through the numbers, right? If you had a $63,000 IRA and you want to do a $7,000 backdoor Roth, your total would be 70,000. If you convert that 7,000, 90% of it's going to be taxable, right? So it just takes that into account. Another way to do it is just to convert the whole dang thing, right? Just say, hey, you know what? I really like Roth IRAs. I'm going to convert all 63 and we're good to go. Or you could push that 63 potentially into an employer-sponsored plan, because a 401k, those are not subject to the pro rata rule. So again, this is getting into some nuance, and happy to go through this in detail with anybody. But just being mindful of where your considerations, right, for what sorts of resources you have, where they're at, the tax status, can help you understand if you qualify for either Roth contributions or backdoor Roth contributions. Okay. All right. So, I've shown this report before, but one of the biggest things that clients always come to me and want to be mindful of is Medicare Part B premiums, right? So, am I going to get, that extra premium increase? So, I'm going to walk through our tax planning software. And when we think about some of the considerations for all of these different strategies that we have, it's a lot of different moving parts, right? It's like, okay, what is your marginal tax bracket? What are the Medicare premium breakpoints? What are our different income sources, whether it's earned income or pensions or Social Security, which all can potentially get taxed slightly differently? Your ages of you, your spouse, your kids, your spending needs, family legacy goals, all of these different parts are extremely important. So I'm going to share a different screen here, and hopefully I didn't get logged out. So just bear with me a second as I get this shared. So hopefully we can see this screen here. Is everybody with me still? Ryan, we good? Okay. All right. So what we do for this, and this is something, again, we're happy to do for anyone that is interested in getting some of these reports put together from a tax perspective. I changed the names of the client, but this is a real client circumstance here that, we just basically say, okay, what's your income for this year? What is your taxable interest? How much have we realized? How much in qualified dividends do you have? What are your IRA distributions for the year? What is your Social Security? And then what is the taxable amount of that? What are your long-term capital gains? We're literally just taking the information we know, especially here at the end of the year. We should have a pretty good sense for where we're at. And when I run this through the software, it's going to take into account the standard deduction. This is the enhanced senior deduction that's out there. And it's going to give us a net tax burden down here at the bottom. And if these clients did absolutely nothing, they would only owe $440 in federal tax and only owe, or they'd get a refund of $22 from the state of Colorado, even though they didn't even withhold anything, which is wild to me. But as we look at this, if they did nothing, their income tax is effectively zero. They're down in this 10% marginal bracket. There's really no income or tax that's going to be paid. But it's like, are we missing out by not converting and taking advantage of these 10 and 12% marginal rates, which are as low as tax rates are going to be in any foreseeable future, right? Like, so the idea is, should we realize maybe more capital gains? Should we realize, more taxable income? And that's where understanding what our resources are and what our needs are, we wanted to convert $65,000 of IRA to Roth for the year. And ultimately, and then again, all I do is put the Roth conversion line in there. And what we see is that now all of a sudden they owe $8,000 in federal tax and $1,700 in state tax, but they've moved a huge chunk from IRA to Roth IRA that's going to help minimize required minimum distributions and is going to get that money over there in as low of a tax bracket as they're going to have for the rest of their lives, right? So just understanding this and knowing how it can tie together is extremely helpful. The other thing, and this is specific to Colorado, so anybody that's a Colorado resident, you get a deduction for income, retirement income. And in the first example, all we had was income for the spot for the husband. And so they only got 24,000 of a deduction. But because we did the Roth conversion in the wife's name, they maxed out their exemption from state income of retirement income, and it saves them a bunch of money on their state taxes as well. So little things like this are things we're happy to go through and keep track of. And again, these reports are very easy for us to put together if we know the information and you can share that with us. Another example we can tie to, and again, this is same client, but I'm going to just run a different kind of scenario, is for if we have younger clients, right? Somebody that, you're in your 30s, 40s, 50s, you're earning money, and you share with us, okay, Bob, Nora, here is, if I can zoom in here, there we go. Got me to zoom in. Here is how much I earned for the year. I earned 300,000. Here's how much my spouse earned. Your deferrals, how much federal, like this is just getting us an up-to-date paycheck, and we can push these numbers in there to help us to understand, okay, how much are you going to owe at the end of the year from a tax perspective? And in this scenario, just understanding, hey, we're going to owe about $7,000 in taxes come year end, just helps you to empowers you to learn and understand what may be there. And then we can say, okay, well, what if we do an $8,300 HSA contribution, right? We max out our HSA for the year because we're eligible and we're able to do that. Again, I'm just making up a scenario. It could be a million things we could do. But then we can see in real time that lowers your federal tax bill by $2,000 and your state tax bill by a couple $100s, right? So taking this and putting it in kind of real world examples, this is that example, just kind of in that tax report again, helping us to understand our marginal rates, how we're going to be impacted by Medicare premiums or any number of things, can be hugely beneficial to clients. And we've seen a lot of people really enjoy and like going through these reports. Okay. Any questions from anybody on these reports or how these work or ways in which we can, put these together for you? Please feel free to reach out and stop us. But, just kind of wanted to go through that at a very high level, and we'll get back to the presentation here. So let me just reshare. And are we back to the PowerPoint here, guys? Okay, perfect. So again, if there are any questions or anything that we didn't cover, please feel free to ask us. But just to recap, the things that we should be thinking about leading up to year end: tax loss harvesting, and I would add capital gain potential harvesting, right? If you're potentially want to realize some capital gains on your holdings, contributions and required minimum distribution review, reviewing your capital gains and dividends, especially if you have mutual funds that are held outside, Roth conversions, charitable giving. We did some live examples, and now we're here for Q&A. So, again, just to reiterate, if you want to dive deeper into 1, 3, or 4, they're on our website on the media tab. We encourage you to go watch those. Or if you want to dive into anything for your specific situation, please reach out to me, Nora, Adam, Ryan, Shaun, any member of our team. We're happy to go through this and make sure you're prepped for leading up to the end of the year. Okay. Nora, anything to add or any thing that you've seen come up for clients that would be interesting to just kind of share here as we wrap up for the evening? Or Ryan, any questions come in?
No more questions yet.
Okay.
I think the point of this whole presentation, right, is to give clients options, to give them data so that they can make an informed decision. And I really love that holistic plan, getting used to working with clients through that. It's just providing transparency, right? So like I said, you
Mhm.
said earlier, you may not qualify for all of those. We want to give you the breadth of things that we do look at. And if you have questions, if it just like puts a little nugget in your mind thinking, does this make sense to me? We're here just to make sure that there's transparency and that you can make an informed decision to take advantage of everything that you can for the year. So, I know it's
Yep.
pretty high level, not going into depth. Didn't want to take the whole time here just hearing Bob and I talk and just kind of But hopefully this raises some questions, or if there's topics that you guys want to learn more about that we haven't talked about in depth, please send that to us. We're happy. This is what we're here for. This is why we do these monthly webinars, is to educate you and just, again, so you can make an informed decision.
Yep.
We did have one comment come through. I'm not sure. It just says gifts to family members. So I think maybe that means, is that, something that can be used as a deduction, or what's the question there?
Yeah. Yeah, so you can give to family members. It's up to what, 18, 19,000 per person per
Mhm.
beneficiary this year. Before you have to file a gift tax return or do any of that. So you can give cash, stock, gifts, any number of things, but you don't get any tax deduction for it, right? So there's no tax owed by the recipient. There's no tax due by you if you give, any number of dollars to a recipient. All that happens is if you go above the gift tax exemption, which again, I think is 18 or $19,000 for this year, somewhere in that area. But say it's 19,000, right? If you go over it, all you have to do is file a gift tax return, and then that just lowers your lifetime gift exemption, which currently is like $13 million or something like that. So you kind of got to keep track of that. But giving to family members can be a great way to share in some of that legacy planning or inheritance, and be able to see them enjoy those dollars before you pass away and just leave them a big chunk of money. So that's certainly something that, yes, is we're happy to discuss and review, but there's no tax implications, regardless of how you shake it up with those.
Yeah, I know about there was one client that was looking for some tax advantage way to, I don't know necessarily if you call it gifting, but depending on the state you are, if you have grandchildren and you want to gift them something, we have some clients that will donate to or contribute to a 529. So
Hmm.
that's where maybe potentially, depending again on the state that you're in, like for example, if you're in Ohio, I think you can deduct up to 4,000, as long as you're a
Hmm.
resident of that state and contributing to a 529 in that state. That was kind of a way around, gifting option
Hmm.
for them for a tax benefit.
Yep. And then you get a tax benefit for the 529 contribution. But if you're in the state of Texas, for example, that does not have state income tax, you're
Mhm.
not going to get any benefit from a state income perspective for contributing to a 529 for a grandkid, kid, niece, nephew, friend, family. It doesn't matter, right?
Mhm.
It can be anybody. But
Mhm.
good point there, Nora. Okay. Anything else, or we good to wrap up here for the evening?
Nothing else has come through. I think we're good to wrap up.
Okay, well, I'm going to do my, responsibility of putting this beautiful disclaimer up here just to make sure that this is all for educational purposes. But first of all, Nora, thank you so much for being, my right-hand woman here this evening on, going through things leading into close. Ryan, thanks for all the tech support and everything. Want to reiterate, happy Veterans Day, and thank you to all our veterans. So thank you all for joining us this evening. Hope you learned something. And feel free to reach out if you have any questions, concerns, comments, or any way that we can help to make sure that you finish up 2025 strong and are heading into 2026 great. So thanks everybody for being here, and we'll see you next month on our next webinar.